Everything you've been told about small business tax is wrong.
Billionaire Warren Buffett and his secretary, Debbie Basanic. She's in the spotlight right now for paying a higher tax rate than he does.
Right now, Warren Buffett pays a lower tax rate than his secretary.
We don't think it's fair.
Amazon is a very sophisticated tax player.
Amazon is very much the canary in the coal mine.
Hang around till the end of this video. I think you'll be singing a different tune. Here in the US, sophisticated investors, big corporations pay on average 0 to 20%. Small business owner, highest average tax rate, 40 to 60%. Seems unfair? Turns out small business owners can pay the same average tax rate as the sophisticated investor, big corporation. Just things you're gonna have to do differently. Step one, get the right entity structure in place. Typically what we're going to recommend is that you're going to form a holding company based in Wyoming or Nevada. That holding company is going to own your interest in individual companies. Why Nevada or Wyoming? They're one of the 7 states with no income tax, and they have the strictest privacy rules. This holding company structure is going to allow you to have entities or partnerships. So they allow for flexibility for you to add partners, make it easier to sell those businesses, but ultimately everything rolls up into this holding company. That's where you're going to optimize it for various tax deductions, probably make a selection to be treated as an S Corp. So we're going to minimize income taxes and the self-employment tax. At some point though, as you grow, you might consider adding in a C corporation. C corporation is an entity that's taxed on its own. It pays a flat 21% tax rate under the current tax code. You may do something called arbitrage. You have a relationship between your C corporation and your other pass-through businesses. That relationship needs to be arm's length, it needs to have substance to it. We can't just shift income between the different companies. But because tax rates are constantly changing, tax rules are constantly changing, sometimes C corporations are the most favorable, sometimes pass-through entities, partnerships, S corps. So proprietorships are more advantageous. By having both, an arbitrage, take advantage of whatever is the most optimal. And then lastly, you may consider injecting something like private placement life insurance, study some of the things that the billionaires are doing, like Mark Zuckerberg with his private foundation and how he's added life insurance contracts, a type of structured investment into the mix to significantly shield future income from taxation. Now, that's a very advanced, sophisticated strategy. It's going to require typically your net worth to be greater than $2 million to participate in that. So that's a long-term strategy for you to consider. That's why you need to be net worth focused. Ultimately, continue to grow your net worth because it gets easier to make money as you have money. You get access to different types of products and structures that you couldn't otherwise access. Real quick, if you're watching this video and you're thinking, Dan, how could you be my CPA and we could do this all together? Well, go down to the pin link below, or the description below, click on the first link. That's going to take you to my website where you can schedule a quick call and see if it makes sense to work together. Now let's get back to the video. Now I'm going to walk you through how to get access to tax deductions and tax credits like you've never heard about before. See, there's this misconception out there. Hey, IRS writes the rules and I got to follow what the IRS tells me to do. It's really a fear-based narrative that's out there. And a lot of CPAs behave like they work for the IRS. They tell you what you can't do. They are the fun police. I get it. They're trying to minimize their risk, but that's not ethical in my opinion. You have an obligation as a CPA to advise your clients on all the risks because at the end of the day, it's your client's tax return. Now, there's certain things you can't do as a CPA. You can't sign off on anything that has a less than 51% probability of being successful. But you still have an obligation to educate your client on anything 51% and above. They choose. Now, the IRS doesn't actually write the rules, they interpret them. Congress writes the rules. The IRS was given permission to enforce it through the Department of Treasury. And what that means is that those who have a lot at stake, the sophisticated investors, big corporations, if they're willing to take on the risk and challenge the IRS on positions that they disagree with, they're going to take that to tax court. Tax court becomes, and could be eventually elevated to the Supreme Court, but the court system really litigates what is a valid deduction or credit. Now, the beauty to you is that that becomes public information. That means that you can copy those strategies as well. So my job in working with clients is to continually stay up to date on the new tax court cases that are coming out involving and allow my clients to then copy those blueprints into their own business and get the same benefits that the big corporations and sophisticated investors are accessing. And it turns out in following that model, you're taking on less risk. But because somebody else already fought it out in court, now you're just going to copy it. The IRS publishes audit manuals. It's public information. So we can go and look and see how they're going to specifically audit certain strategies, what their positions are on things. And then again, copy what they want to see. We're reducing risk. We're making things more deductible for you at the same time. That really is the game. Pay less tax, but also have less risk. Because again, our focus is on growing our net worth. We don't want things that might blow us up later and take us back, reduce our net worth. Now, if you're sweating tax time, I'm here to tell you that things can be better. Things can be different. What we've been talking about so far is really switching from always being focused on the past to being proactive. So we're going to get the right entity structures in place. That's going to be future focused based off our goals, and we're going to create structures where we have a lot of flexibility. We're going to focus on growing our net worth so we can access more advanced strategies. That's future focus. We're also looking at new court cases and IRS audit manuals and seeing how can we apply those to your situation. That's, again, future focused. Tax deadlines are knowable. We know it's going to be March 15th for businesses, pass-through entities, April 15th for personal and C corporations. We know that we can file extensions. We know that once the year is up, most of the opportunities have gone away. You can also pretty quickly figure out your tax liability by looking at your current income and taking it to the tax brackets and saying, okay, you're in this range, so you're in a 22% rate right now. So we take your total profit each month times 22%. That's how much you need to set aside. So we can find your starting point. But ultimately, as a business owner, you're legally allowed to reduce your entire profit, taxable income, to zero. All business profits can be offset through things like real estate losses or other business losses to take them to zero. First off, we're able to calculate your tax rate at all times. It's knowable. Each month you should be looking at your P&L, you should know your tax rate, and be able to reserve money. In addition, we're proactively implementing strategies to continually reduce that tax due down below what you've projected. So all that additional money that you recover, because you've already been setting some aside, becomes actual free and clear money that we can take to reallocate to grow your net worth and acquire assets that are going to create more tax benefit for you. By having this proactive plan where we're reserving your tax liability each month and simultaneously working to reduce your tax bill, tax day becomes irrelevant. You already knew what you owed, you already have it set aside. Anything that we've reduced becomes extra money that you can use to reallocate towards goals or acquiring more assets to reduce your tax bill. So March 15th is irrelevant. At some point, yeah, those returns need to be filed, but everything's been set aside. There's no surprises. It comes like clockwork. That's why we file extensions for all of our clients in January. As soon as the filing systems are open, we follow those extensions. They already should know what their tax liability is. They already have the money reserved. And now it's just a matter of what's the most convenient for each of our clients for when they can get us the documents to finalize the return. But that April 15th deadline no longer matters. There's no hidden surprises where you're just waiting. When are they going to call me and tell me what I owe? That's not what the big corporations, sophisticated investors are doing. They are reserving those funds month after month, proactively working to mitigate, reduce that as close to zero as possible. That's why you don't need to continue to pay 40 to 60%. You can play at the same level as a sophisticated investor, big corporation, get your tax rate to 0 to 20%.